Welcome back, folks. This is our 5th lecture on Smart Money Concepts Module 5. And today we're going to be learning about fair value. What is fair value? Fair value is the fair price deemed by the market makers to trade the market. And fair value is of two types. We have fair value at the equilibrium of a range. And in our previous lecture, I explained equilibrium, discount, equilibrium, premium. So equilibrium is a midpoint in the price range from the premium to the discount. And the second one is fair value as regards to market makers for accumulation and distribution. These are the two types of fair value. I want us to understand that fair value is just the fair price, simply the fair price for purchasing assets, or I would say is a price for buying and selling in the marketplace. So I'll give an example. I'll still use an iPhone. Let's say I purchase an iPhone for $200 and I use it for like 4 months and I want to sell it. So if I'm selling it, I'll sell it like, let's say $170,000. So that price is fair in the sense that it's okay. It's not too expensive, it's not too cheap. It's a price that me and you can agree, and there will be no loss on both ends, because it's a price I purchased 200,000, but I used it for a particular period of time, which will cause the phone to depreciate. And then me selling it back to you for 170 is me getting my money back and the services the phone provided for me with that space of time. Now, don't look at the money, just understand the whole concept here. The whole concept is that you can buy at a price that is okay, that you are not at a loss, but instead it is beneficial to you. And me also the seller, I'm not also at a loss, it's also beneficial to me. So that 170,000 that I'll get from purchasing the phone, I can use it for something else after benefiting from the services of the phone for a particular period of time. Do you understand? Now, the second point I would like to also let us understand is that fair value is not set by we retail traders. It is the price that the market makers regard as fair. So it's what they think is fair for them to buy or sell. So we see this handwriting on the market and then tend to follow them as they make market move, because it is not you and I that make market moves, it is the market makers. So what they see as fair price, let's say they see price at this point and it is fair for them to buy, we know that this is when the market makers want to buy. So we buy with them and make potential profit with them. So that's very important for us to know. Now we are seeing that fair values of two types. We have fair value at equilibrium and then fair value when market makers accumulate and distribute. Accumulation is another word for when they enter orders into the market, or when they buy or sell by entering. Then distribution is when they come out of a trade, it's when they liquidate their trade. So if they buy by accumulating, for them to come out, which is distribution, they will be selling. Like I explained before, when you buy to close a trade, you will sell. You need to sell to close that trade. And if you sell, closing the trade, you need to buy to close that trade. So accumulation is when they are entering the market. Distribution is when they are coming out or liquidating their position. So there are two types. We have the fair value at equilibrium price and fair value at accumulation and distribution. So I've already explained to some extent fair value at equilibrium in our previous section, the premium and discount. But now we're going to be going in depth to the second part, which is the fair value as market makers use for accumulation and distribution. So fair value as regard to market makers, it is the discount price for them to buy, like I said before, or premium price for them to sell. Market makers don't buy or sell anywhere. They want to sell when price is very expensive, and they want to buy, and they want to buy when price is cheap for them to make potential profit. Now we read their handwriting and follow to make potential profit. So now let's say this is a price range. You all know what the price range is. And then the midpoint is the equilibrium. Now, below the equilibrium is the fair value. This part below the equilibrium forms the fair value. And market makers tend to enter their orders at this point in order to liquidate that position above swing highs where you locate buy stops. So I'm sure we are getting the concept now. And then we see this for a sell trade. This point to this point is a price range. Now above the equilibrium is where we find fair value. They don't want to be selling when price is at this point below the equilibrium. They want to sell above the equilibrium. So from the equilibrium to the beginning of the range forms the fair value. It's the price where price wants to go to accumulate sales in order to liquidate our positions below the market where you will locate sell stops. Sure, we understand. So now let's go into the chart. So that we can see it in depth and how to locate what a fair value actually is. How does it look like? Where is it located? And how can we read the handwritings of the market makers when they're accumulating and distributing? This dollar index in present time. Now look at this. Price formed the range from this high to this low. This is a range from here to here. Price from a range. Now, as price moved from this point to this point, it formed what we call fair value gaps. So how do you identify fair value gaps? Now look at this up close candle. Like I said before, the up close candle for a down move is a bearish order block. And then the down close candle before an up move is a bullish. You can see here is an example of a bullish order block. Here is a bearish order block. You can see it here. And here is a bearish order block. This is the up close candle, and this is two candles. So the two consecutively. There's no black candle in between these two candles. They are all up close candles. So this up close candle before the down move formed another block, and we see how price reacted here. Okay, now let's look at what the fair value is. Now, as price moved downwards, you discover that there was no buying occurring from this point to this point. Look at it. Price moved up and then came down. Now, from here, you can see that there was buying and there was selling. So price is balanced. But from here, I'm using the body of this up close candle. So this point here, there was no green candle. There was no up close candle. So my up close candle are the green candles. And then my down close candle are the black candles. Meaning that the green ones are the ones going up, and then the black ones are the ones going down. But if you look closely here, you will see that from here to here from here to here were up close candles. And then from here to here were down close candles. So it was balanced. Here, price is balanced. But from this point here to this up close candle, there was no up close candle. So all that occurred from here to here was just selling. So this point to this point here is fair value. Market tends to return back to fill in the gap. So it is called a fair value gap. Now we can see another one here from this up close candle. I'm using the body, this open of this up close candle. So this up close candle. We only had down close candles. There was no up close candle here. Forget about the wick. I'm using the body. Now look at how price returned back to close this fair value gap. Now we can see another one here from this point here to this point here. It was only selling that occurred. Buy that occurred from here to here. Then from here to here, sell. So buying and selling. So this gap was closed. But from here to here, there was only selling. So it created a void. And then we see how price closed it up. I'm sure we understand. Fair value is formed in inefficiencies. What do I mean by inefficiencies? If there is only buying occurring in one side with no selling to balance out that range, it is an efficiency. We see here that there's only selling from here to here that was formed. So there is an efficiency from here to there's an inefficiency from here to here. So price tends to go back to close, like I explained before. When you are painting a wall, let's say you start from below and then you begin to move to the top, you discover that if you go down, you see that some places were not properly painted. So what happens? You tend to go back down to paint it properly so that the whole paint will be even on the wall. That's the same way it works. So this area of inefficiency, price tends to go back. So this platform here is called fair value. Now we see another fair value that was formed here. Price went up and came down. So this part is balanced. But from here, this point, we're using the bodies now, like this before, to this up to, because actually, let's assume we didn't see this price here. Price printed down, so there was only selling, but price returned back to close up the gap and then left a little part of the gap unclosed. From here, the low of this down close candle, sorry, the open of this up close candle to the close of this up close candle. So there was a gap. And then look at how price returned back to it. So now, when price prints another block and moves away from it, from the point where it gets to where that up close candle was printed, which we regard as the other block, that range is fair value for market makers. So they tend to take price to that point, which is why price tends to react from another block. So we see how price moved from this point here was what formed, because price here took liquidity. And then look at the move. The move was so abrupt, was so fast. It moved. This is a daily time frame. So it actually moved very fast. So price returned back to it. And look at the reaction here. Here, we'll classify it as distribution from the longs that they took from here, from here, from here. So I'm going to explain a little about equilibrium as fair value. So I'll take my fib. Okay, let me remove this. So from this range here to this range, we have an equilibrium. This point is the equilibrium. Anything above the equilibrium is premium. Price is expensive. Anything below is discount. So price moves from discount to premium, from premium to discount, from discount to premium, from premium to discount, from discount, like that. That's how price moves after creating a range. So this line here, we can see this dotted line here already serves as equilibrium. So let me just take this out so that it doesn't confuse us. So we know that this line here is equilibrium. Anything above is premium, anything below is discount. But let's look at what happened here in price. So price moved, created another block, and then left a gap. It was filled partially, and I left a gap, which is fair value. Then price moved again, created another gap, which is a fair value gap. Price moved, created a fair value gap, which is what formed by what? This up close candle, and then this up close candle, this gap between these two candles. They formed a gap, and then price returned to it and closed it, and then moved aggressively, forming another gap from this up close candle, this two up close candle here, buying, selling. But here, they left a gap. So price left it and then ran down. After which price continued to rise to close this fair value gap. From where? From discount to premium. This fair value gap is at premium. Now let me explain something to us so that we understand the dynamics of how price moves from premium to discount. Now, within a range, you can also take trades. Now, look at where price is where at premium, filling in a gap. So we expect that there will be an offloading of trades that the market maker might have taken from here. So offloading, another word of offloading is distribution. So there will be a level of distribution which will cause a retracement. So now look at it. I want us to understand that we can trade within price ranges as long as we know where the market is. If market is at premium, we want to be selling. If market is at discount, we want to be buying. So look at what happened here. Market moved from discount to premium, filling a gap, which is fair value created during this price movement. As price filled it, price retraced, breaking structure. It retraced where? Into discount. So now we can draw our fib. Let's look at this. Draw our fib from here. Make it deep. So we can see that from this point to this point, formed a range. After closing this fair value gap, and then it did what? It broke structure and is at what? Premium. So price formed a range. So we can draw a fib here and then look at how price retraced to equilibrium. Now let me show you another thing again. That price was hitting. Let me take out the equilibrium. We know that this part, this point here is equilibrium. Let me take it out. This is what? a bearish order block. Price ran into this bearish order block and then rallied because it is at premium. This is premium, filling in a fair value gap. So we expect that the market makers will be coming in here to either distribute or accumulate trades. But at this point, we are expecting them to distribute trades here. So they are buying here to distribute some of their trades here. So let's say you buy here to come out, you'll be selling, but they won't be offsetting, or I would say distributing all the orders they entered. So let's say they entered 200 orders here with 200 volume. They will be coming out with like a partial of 50 volumes or 50 units, just for example, and then with hopes that price would reaccumulate and move up to distribute part or all of their orders. So we see this handwriting. So now look at how price moved to this fair value gap here, where we expect what? The market makers to come to distribute their trades after taking some longs here. I hope you understand. So price hits to close this fair value gap, broke structure, and then formed the range. So if you draw your fib from this point to this point, you will see that this purple area here is the equilibrium, and then price was hitting a bearish order block at a premium. So we see how price reacts. Then now I will show you another thing again. From this point to this point, price formed a range. We can see this range here. So price retraced down here to equilibrium, and then look at how price consolidated before moving. It rallied. Now, it is very easy to know where price will go from when price gets to equilibrium. The direction of highest probability for price to go to can be determined from the recent structure that was broken. So now look at how price moved from this point to this point. It broke structure. So if price returns back to equilibrium, we expect that price would continue upwards because this structure here was broken. So let's look at this point again. Let's look at this other one. Price reacted from here and formed the range. What was the most recent structure it broke? Here. So if price returns back to equilibrium, which is fair price, we expect that price would go in the direction of the structure that was broken, because this was the structure that was broken. The same for this one too. So price moved, breaking structures. It broke structure. And then if it returns back to equilibrium, which is fair price, we want to see price continue. So we are not breakout traders. Breakout traders, let me draw it here. What they do is that once price is ranging, they set their orders here. They expect that as price moves, their order is triggered for them to continue in the buy position. No, we expect price to actually break out. We know that price will break out in this direction because price was coming out from this point. So after breaking out a structure here. So if price consolidates like this, we want it to break out. We're expecting it. So after breaking out, we want it to return back to equilibrium, which is a fair price. And mind you, we want it to be below the equilibrium price, which is discount. This is where we are expecting market makers to come in to continue the trade. I'll show you another example again. See how price reacted from this consolidation after coming from equilibrium of this range, from this point to this point. We see how price reacted and then formed another fair value gap, because from this black candle here, this down close candle to this down candle, there was nothing here. So price came down and found support in this fair value gap and then rallied, breaking what structure. It broke structure here, broke structure here. So now we're going to draw a fib from here. So we see how price return back to what? Equilibrium in this range. And not just equilibrium, return to this order block. And then on this order block, it returned to the equilibrium of the overall range. So we should expect price to be what? Bullish. And look at how price rallied, forming a liquidity void here. It rallied quick to close up this fair value, which was originally created from this range. After when the market makers liquidated their buy orders, they took here, here, and here. Because we will call these points here reaccumulation. Even this point here is a reaccumulation, because now look at how price, let's look at this point. See how price moved from this consolidation. It broke structure. So after price was consolidating here, it broke structure. Now price is consolidating again. So we know that once price is consolidating, we expect price to move in the range from where structure was broken. So structure was broken in the upside. So we want to see price continue to go higher. So they reaccumulated some of their positions here, and then price moved, which they liquidated some here, which is the distribution, because there's a fair price. And then price retraced for them to reaccumulate more of their longs, to which they distributed here. Some were also accumulated here. So knowing where these points are help you determine where to come into the market and where to take out your positions. So if you are buying here, you want to be coming out above highs, because there will be buy stops here. And market makers know that there are stops here. So they want to take their price out. So they want to take their orders out of the market above recent formed highs. So we have this high here. We have this high here. And look at how price went. Took this high with this run, and then took this high with this run. All right, let's look at another example here. So price consolidated, it moved, and then broke structure. So we want to draw a feed from here to this point here. So look at how price broke structure and then started consolidating. It moved down to equilibrium. Where do you think price will go next? And it's at discounts from this range to this range. From here to here is at discount. What do you think price will go? And we know that there is a fair value gap formed at the premium, where we know that market makers tend to accumulate or distribute their orders. So what happens? So we know that price will actually get to that point. And we know that price moves from discount to premium. So we see price at this point after breaking the structure coming from this low. So it's price will go bullish in order to close this gap, and that's what we see here. Okay, let me explain it again for proper understanding. Now, price made a move from here to here, forming a range. So I'm going to draw my feed now from here to this point. Now, price came all the way from this high to this low at equilibrium. Now, this point is a discount from here to here. This is the parent range. So we know that here is discount, and this point here is at equilibrium. It is fair price from here to here. Another thing I want us to know is that this fair value gap wasn't completely closed. It was partially closed here, but it left a gap here to here. Let me show you. Let me roll the fib. Now we see that this place is at equilibrium. This purple shaded area, it is equilibrium. So I want to remove the fib so that we see something clearly. Look at this gap from here to here. It was not closed completely. So once price is returning back to discount, that is fair price, price moved to close up the gap which was left from this high to this low here. So look at how price closed it perfectly before returning back again to the overall equilibrium of this range, and then the equilibrium of this other newly formed range that was formed here. This newly formed range broke this high. So we know that price is bullish because it broke a high. After returning, we expect price to be bullish. Now, another thing is that there is also a fair value gap which was also created here, and price has not closed it yet. So we expect to see price rise higher. Not just that, another block was also formed here, and we know that the down close candle before a up move is what forms the bullish order block. So this down close candle before this move, this rally, formed a bullish order block. So we see that there are a lot of confluences. Now list them again. Price moved from equilibrium by this range to this range to break a high, after which it retraced down to what another block formed. And this point, this segment here, is at equilibrium. And we know that equilibrium is fair price. And look at how price bounced on equilibrium. It didn't spend much time because it is on a quick move to get to the fair value. So price moved from this point here quickly and then close this gap. So we are seeing that there are a lot of confluences. We don't just say, because the market is on premium, let's sell. Market is on discount, let's buy. No, we combine a lot of things to give it context. We have to understand what market makers are doing. Now, I'll explain what market makers are doing for us to understand again. After coming this range, price left fair value gaps. And I think for fair value gaps are where market makers tend to accumulate or distribute their orders. Distribution, I mean liquidating. Accumulation, I mean entering the market. So now, after this range was formed, some long orders were taken here, which caused price to rally. And not just rally to any point, but to rally to fair value. And this fair value is at premium, where they will liquidate part of their orders, not all, which causes price to retrace. Now, as price retrace, if you draw your field from here to here, price is not just retracing to a random place, it is retracing back to equilibrium from this range to this range to a discount from parent range from here to here. This area here is the discount, this area here is the premium. So price retrace down. And then another thing we just want to combine is there was a liquidity void here. Look at this point here. Let me pull it out. Here and here is a void. See how price reacted here. The bodies respected this void. And the other confluence is that these two relatively equal lows. What do you think you'll find here? Sell stops. So market retraced down, took out the sell stop, closed this gap at equilibrium of this range and a discount of this premium range for market makers to accumulate more orders. And these orders made price to rally again to close down this little gap that was formed here, that was not completely closed, breaking structure, telling you that market wants to continue going high because it broke structure after taking out liquidity. So then, market retraced again to an order block here and the equilibrium of this range, after which it closed partially of this fair value gap that was formed there, closing partially, found support, rallied, broke structure, closed this gap here, and then retraced again for reaccumulation of orders. And the market rallied aggressively to this fair value gap, which was originally created by this order block, where they liquidated majority of their orders. So we see how price has been moving afterwards. In trading the forex market, a very good understanding of where price presently is will refine your bias. For proper context, a price range is composed of three main components. Number one, premium, the discount, and the equilibrium, which is the midpoint of the price range. Market moves in price ranges most of the time, from premium to discount and from discount to premium formed by the range. By defining price in current trading ranges, you will be able to see where the market makers will expand price to. It's all about knowing where the discount is and where the premium is in a price range. So if you open your chart, what you're looking for is what is the most recent price range that has been formed? Where is price trading in now? Is it at premium or discount? The second thing is locating fair value. Is price at equilibrium or at a fair price according to the market makers? So if you know where fair value is, you can be able to tell where market will go next. You can be able to anticipate the movement of price. So I'll move on this mentorship. I'm going to be helping us identify where fair value are located in price and how to anticipate market moves. So as all times, I wish you all good luck and good trading.